If you deposit over $10,000 in cash in a single transaction, the bank is legally required to file a currency transaction report, also known as a CTR. They file this with the Treasury Department, and the IRS has access to that data. The reason the IRS knows how much money you make is simple. The law requires companies and financial institutions to send the IRS a copy of the same W-2s and 1099s that you receive. Every dividend, every bit of interest, your wages, and even money from payment apps like Venmo might be reported to the IRS under your Social Security number. You can even see their data yourself. Just access your IRS online account and view your wage and income transcript. This transcript shows every business that sent the IRS information about you. A crucial distinction. Often, the IRS knows the gross sale of your stock or real estate, which is reported on a 1099-B or a 1099-S, but they often do not know your cost basis, which is the original price you paid for it, plus any money you have spent since. This is why keeping records for assets is essential. The IRS will assume your basis is zero if you can't prove it. But what about cash received by a business or rent paid in cash? The IRS doesn't know the exact dollar amount of cash that you received. However, that doesn't mean you don't have to claim it on your tax return. The IRS uses two major checks. Number one, industry comparison. The IRS's main algorithm, which is called the Discriminant Information Function, or a DIF score, compares your cash-intensive business, like a gas station or restaurant, to other businesses in your industry. If your gas station is depositing a lot less cash than the competition, or your profit margins are way lower than the national average, the computer flags that discrepancy. Number two, if you deposit over $10,000 in cash in a single transaction, the bank is legally required to file a currency transaction report, also known as a CTR. They file this with the Treasury Department, and the IRS has access to that data. Large, frequent cash deposits are a potential red flag. If your rental property is always operating at a loss because you don't report cash rental income, this will also raise a flag, making it hard to prove you didn't receive the rent. The IRS isn't just looking at income, they're looking at assets and lifestyle. They can check public records like property deeds, DMV records, and even Form 1098, mortgage interest statement. They can do this to tie assets to your name. This lets them run the lifestyle audit. If you're spending on a new luxury car or home doesn't match your reported income, you're looking at a problem. If the IRS thinks you are not reporting all your income, they may ask you to provide support, starting with your bank statements. If you don't provide them, the IRS can use their biggest power to get them, the IRS summons. This is a different process than a subpoena. A subpoena must be signed by a judge. An IRS summons is an administrative tool approved internally by the IRS itself. If you refuse to comply, then the IRS goes to a federal court to enforce the summons. But the initial demand is much faster and easier for them to issue. Once the IRS has your bank statements, they can use indirect methods like the bank deposits method to prove that cash deposits clearly exceed your reported income. This imbalance is powerful evidence that can be used to prove tax fraud.